Hello and welcome. My name is Ed Newton with Newton Wealth Management. We put these podcasts together to help you as you continue along the path to achieve and maintain a worry-free retirement. We hope you'll enjoy this one and find it beneficial. Whew, what a year. As we begin a new year, I want to touch on 2 points. The tax law changes that affect investors, and what does the stock market returns for 2019 tell us about returns for 2020? Let's talk taxes first. On December 20th, President Trump signed into law the Further Consolidated Appropriations Act 2020. The main point of the law was to continue funding of the government and avoid a shutdown. But as Congress often does, there are other provisions that found their way into the act. There are a few provisions that affect income taxes, but I just want to focus on the portion that may affect you if you have an IRA or other retirement plan. You probably know that if you have an IRA, you must begin to take withdrawals from it at age 70 and a half. In other words, a required minimum distribution, or RMD. And at that point, you must stop contributing to your IRA as well. The SECURE Act, which was buried in the new law, made a couple of changes that benefit investors. The biggie is that you may now wait until the year you turn 72 to begin taking your RMD. It also removes the age restriction on making additional contributions to an IRA. The change took place on January 1st. If you've already begun taking the required distribution and are less than 72, you have to continue taking them, but you can make additional contributions if you otherwise qualify. If you turn 70 on July 1st, 2019 or later, you do not have to start taking money from your IRA. On the downside, though, the Act eliminated what we call the stretch IRA. Previously, if you inherited an IRA from someone other than your spouse, you were required to take distributions over a period of time according to an IRS table. That meant you could take the required distributions over your lifetime, which would allow the account to continue to grow. The new law means that a non-spouse beneficiary must now withdraw the money from this account over a 10-year period. This change only applies to accounts whose owner dies January 1st of this year or later. As always, you should consult your tax advisor to see how this might affect you. Let's switch gears now and look at the year that was and the year to be. We will be communicating our year in review and our 2020 outlook in a couple of weeks. But for now, I think we would all agree that 2019 was a wow year. The fantastic year has caused some of the talking heads to argue that stocks are probably out of gas after such a good year and probably won't do much in 2020. I see at least 2 errors in this view. One is looking at 2019 in a vacuum, and 2, presuming that one year's returns influence the next. 2019 was certainly a great year, but the larger story begins back in January of 2018. If you'll recall, we entered a global correction in early January. Then we ground our way through the summer, pushing stocks a little higher. Yikes, then we hit December of 2018 when things got really bad. I believe that decline was caused by one major factor: hedge funds. They believed it made more financial sense to liquidate, close shop, and start over again than continue in that environment. The low point was reached the day before Christmas. That meant that the beginning of 2019 lined up perfectly for the typical post-correction V-shaped bounce that followed. That bounce is responsible for a good portion of the 2019 returns. In other words, a lot of the 32% rise in the S&P 500 went toward erasing a nasty late 2018. But even if a correction recovery wasn't part of the story, a strong 2019 does not necessarily set us up for a blah 2020. Here's a good example of how global stocks often keep going after a great year. Since 1969, when the MSCI World Index began, there have been 16 years when the index rose 20% or more. Positive returns were recorded in the next year in 12 of those 16 instances, 7 of which were double digits or higher. There were only 2 years when the following year was higher, but let's face it, a positive year after a positive year is, well, positive. We can look back even further by looking at the S&P 500. Since 1925, the S&P 500 topped 20% in a year 34 times. The next year was negative 11 times, while the index was up 23 times, 11 of them more than 20%. Now, I'm certainly not saying that 2020 will be a whopping up year. It seems to me that it is a function of the fact that nearly three-fourths of all calendar years since 1925 have been positive years. And with the bull market returns coming in clumps, it isn't shocking that the big years would cluster together now and then. What happens this year will be determined on how the political and economic factors play out and how that reality squares with expectations. Expectations seem to be tame, making positive surprise more likely than not. Bear markets start with investors being ecstatic so that economic negatives are ignored or when some huge unforeseen negative throws the world into a global recession. I don't see either of those today, causing me to think that owning stocks remains the best option for long-term investors needing growth. We've covered two areas today. First, changes in the tax law have been liberalized in the area of required minimum distributions. If you're under 72, you have an additional year and a half at least before you will have to begin taking money out of your retirement accounts. And secondly, even though 2019 was a very good year for investment returns, that doesn't indicate anything to us about what the markets will do in 2020, but remaining fully invested seems at this time to be the most prudent course for long-term investors. We hope this information has been useful to you. Our goal at Newton Wealth Management is to help clients achieve and maintain a worry-free retirement. We are a fee-only firm. That means we don't receive commissions or any other compensation from the investments that we utilize. We have a fiduciary responsibility to our clients, which means that we always put your interests first. If you haven't set a plan or not sure that your plan is appropriate for your goals, we would be happy to talk with you and see if there's anything we can do in order to get you on track so that you too can achieve and maintain a worry-free retirement. If you have $250,000 or more of investable assets, I would invite you to visit our website at www.newtonwealthmanagement.com. There you can find out more about our firm and the services we offer. Again, the website is www.newtonwealthmanagement.com. From the website, you can also contact us to request a no-obligation, no-fee consultation. We look forward to hearing from you at www.newtonwealthmanagement.com. Newton Wealth Management is responsible for the content of this podcast and reflects the current opinion of the speakers. It is based upon sources and data believed to be accurate and reliable. Opinions and forward-looking statements expressed are subject to change without notice. Securities offered through Archer Investment Corporation. This information does not constitute a solicitation or an offer to buy or sell any security. A risk of loss is involved with investments in stock markets. The commentary provided should not be regarded as personal investment advice. Past performance is no guarantee of future results. You should carefully consider investment actions in light of your goals, objectives, cash flow needs, and time horizon.